Well, hello. We're going to have a chat about stop hunting and where to put your stops. Hi, welcome to the channel. If you haven't been here before, my name is Langers, and I am the overgrown child that is the scruffy trader. No shock there then. But what I'm trying to do is kind of put trading in the real world. Maybe show you a trick or two along the way. That sounds good. Please click the little subscribe button. Genuinely helps. And if you like all things trading, smash the like button. So how can you beat the stop hunter, the big monster of the markets? Well, it's not as difficult as you think. The problem that most relatively new, even some seasoned traders for that matter, have with stops is twofold. And the first reason that most people are stopped out is very simply it's too tight. You see, most educators, and there's God knows how many out there, some good, some not so good. You spot them ones. They're the ones that you see on the land of make-believe, or what you call Instagram, and they always seem to drive a green Lamborghini.
You ding dong!
Give it to me again.
You ding dong!
Had to get that one in. But basically what they're doing is they're kind of setting you up for a fall. And what I mean by that is it's lovely to have a 1 to 3. And they talk about low risk reward and all of this, low win rate versus risk reward. Yeah, I agree, but they are symbiont and they go hand in hand. Now, if you're going into the market expecting only to win 40%, you're not really reading the charts in my eyes. You're just taking a punt. You know, if I'm getting somebody to fix my car, I want somebody who can fix it 9 times out of 10, not somebody who can fix it 4 times out of 10. Common sense, because I'll just be throwing sort of good money after bad sort of thing. So what am I driving at with a tight stop? All right, kind of put it into a little bit of context. So say you've got your chart and you've got a level here and you've got another level above it. All right, so bear with me half a second. You've seen the market's gone up like so, and it's kind of stalling a little bit on this level. Brilliant. Straight away, you're thinking, I'm going to short this. And you may well be right, all right? Because it's had a good drive up for a long period of time. It's found a level, and it's now struggling on that level. Okay? So what goes through your mind? You're thinking, okay, I need to be in at 3 to 1. So your 1 is there, and your target is kind of this area here. 3 to 1. Looks brilliant on paper. Really does. Just above support and resistance area, and you're targeting the last swing low. Easy. But that's what you see. But so does everybody else. And the people who have more money see that as well. Now this could be 50 pips away. And what happens is the bigger boys, the stop hunter, they need to fill their orders. So what they will do, they will drive the market up to the new level to take out all of these stops, all of this lot that's dotted around here and here. and their orders to go short will be there. And then the market will continue down. So you haven't done anything wrong. So in a sense that you've just not allowed your trade to breathe. Okay. So when you're looking at this 50 pips, you're thinking to yourself, that's too much for me to bear. Because if you're on £1 a point, you know, that's 50 quid. A lot of money. On £10 a point, it's £500. What are you thinking? So you believe your tight stop is protecting you. But it's not. You see, your tight stop might be 20 pips. 20 quid. So they've just taken 20 quid off you. But you still believe you're right. So you entered again here, and it still went up another 20 pips. So it's now cost you 40 quid. Why is it 40 quid? Could stop you out twice on the same short. Then you finally get it up to there, and that was 60 pips away. Alright, and you win that one. So you've gone through a lot of stress and a lot of pain for no reason. But if you had a wider stop in the first place, you could have averaged into that and made money. And the way you average in is you reduce your position size. So instead of being it's sort of £1 a point, you go in at 25 pence, then put another order in at 25 pence and another order in at 25 pence, all the way up to this level. And you might sit on some pain, but your risk is actually less. I know it sounds a bit odd, but if you think about it, each time you put a price higher up, it doesn't cost as much as the one below it, further up. But if you threw your full position size in at the start, you're at the mercy of the market completely. And then it works the other way, because as the price comes down, you could have that as a first target, a second target, and a third target. So you've actually got more money coming down as well. So that's kind of the power of averaging in, as well as why a wider stop is there in the first place. But that is just one idea as to how to avoid it. I'm not a believer of tight stops, and I think anybody who follows me knows that. And the other major way of being clipped is you place your stops in the most obvious position that everybody else does. And it goes back to the tight, because your tight is just literally, it's too tight. You've only allowed yourself 10, 20 pips when really the market is telling you it should be 50. But if you see market's gone up like so, it's hit your level, it's tested it, come back under and done that, everybody and his dog is going to put their stops there. So again, the professional guys will look at that, just go, yeah, I'm having that, push the market through it, soak up as much liquidity as they need to fill their orders, no more buying, rolls over, comes down. But you don't want the stress of a large stop. You must have sort of 20 to 25 pips stop as part of your plan. Well, instead of having your stop there, why not place your order? Place your order 20 to 25 pips up. Cost you the same. Your new stop is now up here, above that. Just a thought, literally frame your price up. So if you think that your stop needs to be 20, put your order in 20 pips up, or vice versa if you're going the other way, and see how many times you get filled. I think you'll be quite shocked. Both of them are different ways of trading. You know, basically you've got your tight stop, which I don't like. Personally, I have quite a wide stop. I work on 2 structure points. It's either 2 swings or 2 levels, always, because I know the first one will be tested, and then I've got enough time between there and the next one to figure out whether or not I am going to stick with the trade or just kill the trade off. And very rarely my hard stops are hit. I do sit on heat. It's just nature of the game. You know, I'm quite used to it now after many years in front of the screen. But I can recognize when I'm wrong and just kill it. I'm disciplined enough to do that. And another trick that I do as well, if I can't see the market going the way I want, but I'm a little bit unsure, in other words, I still think I could be right, I'll take 50% of my trade off. So I've still lost money, but I've left a little bit on the table. If it turns round and comes back down, it helps offset what I've just lost. And if I was wrong and it did go all the way to my hard stop, I still haven't lost as much as it was when I first put it on, because I've reduced the impact, and that helps me as well. And then at the end of the month, you add all of these up and my risk reward balances out and I do okay. So that's just a little bit of food for thought. A number of questions come in over the last couple of days, and I thought I'd try and put it on a whiteboard and explain it, probably badly, but I'll quickly recap it. Basically, if it's tight, you're going to have death by 1,000 cuts. So half your bid size, but double your stop. Run out of space. All right. So that's how I would combat that. Means your risk's the same, but you've allowed it to breathe. Okay. And 2, if you're sort of in the crowd where everyone else places their stops, that's where your bid is placed. Simple. Okay. So 2 different ways, and hopefully it'll give you some ideas. But back tested, have a look how many times the market has stopped you out on your tight stop and it went to the next level above or the next swing. And see what would have happened if you halved your position but doubled your stop, and see if you made any money. Likewise, if you were to place your order at your current stop and left 20 pips as a buffer for you, see how often that kept you in the game. Just a couple of different ideas. Anyway, sounds good. Be interested to hear your thoughts in the comments below. If you want to contact me, you'll find all my details in the description. Easy found. But as always, guys, do what you love and the money will follow. See you all in the next one.